You know that feeling?
Yeah.
It's it's not like you're tired from the gym. It's that exhaustion you get after a really good year at work.
Mm-hmm.
Maybe you got a promotion, maybe even a decent raise, but you look at your bank account and somehow nothing's really changed.
It's the hamster wheel. You're earning more, but you don't actually have more.
Exactly.
Yeah.
You're running faster and faster just to stay in the exact same spot.
And that is the perfect description of what we're talking about today. It's what our source material famously calls the rat race.
Welcome back to The Deep Dive. Today, we are unpacking a book that, it basically launched the entire modern genre of financial self-help. Robert Kiyosaki's Rich Dad, Poor Dad.
Right. And I know some people might think, oh, that book's been around forever.
Yeah.
But the thing is, its core message is arguably more relevant now than it was back then.
I'd say it's way more relevant. The gap between what people earn and what they can actually afford just keeps getting wider.
Yeah.
And that traditional advice, go to school, get a safe job.
It's just not working for a lot of people. The results aren't the same as they were 50 years ago, not even close.
And that's our mission for this deep dive. We're not here to give you stock tips or anything like that. We're here to decode the philosophy behind this book.
We want to understand why a high income doesn't automatically make you wealthy.
And we're going to have let's just say, a potentially uncomfortable conversation about your house and why it might not be the asset you think it is.
Which all comes down to the source material's context. Because this isn't some dry textbook. It's a story. It's a narrative about two dads.
Right. Kiyosaki frames it all through his own childhood in Hawaii. He says he had two father figures. There was his biological dad, who he calls Poor Dad.
And then there was his best friend's father, who he calls Rich Dad.
And what's so interesting is that at the start of the story, when he's just 9 years old, neither one is actually rich or poor. They're both just starting out.
But their mindset, their whole philosophy about money has them on two completely different paths.
Let's talk about Poor Dad first, because honestly, this guy sounds like a model citizen. He's not lazy.
Oh, far from it. He's the poster child for academic success. He has a PhD. He did his 4-year undergrad in just 2 years.
Wow.
And he eventually becomes the head of education for the entire state of Hawaii. This is a smart, hardworking, highly respected man.
And yet, the book says he struggled with money his entire life. Died with bills left to pay.
Because he followed that standard script. Study hard so you can find a good company to work for. Job security was everything.
So he saw money as something you work for, a paycheck from a safe employer.
Exactly. Now contrast that with Rich Dad.
Who never finished the 8th grade.
8th grade. But he ends up becoming one of the wealthiest men in Hawaii by building this huge empire of businesses and real estate.
And his advice was the total opposite.
The complete inverse. He said, study hard so you can find a good company to buy.
That one word changes everything. Work for versus buy.
It's the difference between being an employee and being an owner. And you can imagine for a 9-year-old kid this was. It was incredibly confusing.
Oh, for sure. Poor Dad would say things like, the love of money is the root of all evil.
And then he'd go see Rich Dad, who would say, no, the lack of money is the root of all evil.
The one that really stuck with me was how they approached things they wanted. Poor Dad's go-to phrase was, I can't afford it.
And Rich Dad actually forbade his son from saying that. He hated that phrase.
Why? It seems responsible, right? If you don't have the money, you don't have the money.
It's honest, but it's a mental dead end. The second you say, I can't afford it, your brain just shuts down. Problem over. No solution needed.
You've accepted it.
You've resigned yourself to it. Rich Dad insisted on changing it to a question. How can I afford it?
So it becomes a puzzle to solve.
It forces your brain to start working, to exercise that financial muscle. How can I generate the money for this? It opens up possibilities instead of just closing the door.
And that really gets to the core of the problem Poor Dad had. He was stuck in what the book calls the rat race.
Right, the treadmill you mentioned.
Yeah.
And it's driven, psychologically, by two really powerful emotions.
Fear and desire. Or greed, he sometimes calls it.
Fear and desire. Let's start with fear. It's that primal fear of not having money, not being able to pay your bills. That fear is what makes you get up and go to a job you might not even like.
Okay, so you work hard, you get the paycheck. The fear goes away for a bit.
For a minute, yeah. But then the second emotion kicks in. Desire. You see that money in your account and you think of all the nice things you can buy, a new phone, a vacation.
The dopamine hit. So you spend it.
Spend it, and then the money's gone, and the fear comes creeping back.
And the cycle starts all over again.
But here's the insidious part. As your income goes up, so does the desire. You don't just want a car, you want a nicer car. You don't just want an apartment, you want a big house with a big mortgage.
That's lifestyle creep.
It is, but it's framed as being a slave to money. You're letting your emotions run your life. And the book points out who you're really working for in this cycle.
And it's not you.
No, it's a pretty brutal list. First, you're working for the company's owner, making shareholders rich. Second, the government. The book says the average person works from January to May just to pay their taxes.
5 months. That hurts to hear.
And third, you're working for the bank, paying off that mortgage, that car loan, those credit cards.
So the money just flows through you from your job and straight out to those 3 places.
You're just the conduit. That is the rat race. And Rich Dad's whole lesson, the way out, is boiled down to one sentence. The rich don't work for money, they make money work for them.
Okay, which brings us to the absolute core of this book. This is rule number 1, and it's where Kiyosaki redefines some words we all think we know. Assets versus liabilities.
If you remember nothing else from this deep dive, remember this. You must know the difference between an asset and a liability, and then you must buy assets. That's it.
But it's not the normal definition, is it? Because an accountant would tell you your house is an asset.
Right. A traditional accountant says anything you own that has value is an asset. Kiyosaki says that's needlessly confusing. He simplifies it down to one thing: cash flow.
So what's his definition?
It's super simple. An asset puts money in your pocket. A liability takes money out of your pocket.
That's it.
That's the entire definition. Does it pay you or do you pay it?
All right, I have to bring up the big one then. The thing that makes people angry. He says your home, the house you live in, is a liability, not an asset.
And by his definition, he is 100% correct.
But wait a minute. My house appreciates in value. I can sell it in 20 years for a profit. How is that not an asset?
Because what is the cash flow direction for those 20 years? Every single month you have a mortgage payment, property taxes, insurance, maintenance.
The boiler breaks, I pay.
Exactly. Money is constantly flowing out of your pocket to support that building. Therefore, it is a liability. The potential profit when you sell is just. It's speculation. It might happen.
So if I moved out and rented it to someone?
Now you're thinking, if the rent you collect covers the mortgage, the taxes, the repairs, and you're left with, say, $200 of profit each month.
Then it's an asset.
Boom. Now it's an asset. It's the same house. The only thing that changed was the direction of the cash flow. And this is the fundamental difference in how the classes handle money.
Right. He lays out the patterns.
The poor earn money and it all goes out to expenses. The middle class earns money and they buy liabilities that they think are assets. A bigger house, a fancier car. They're just increasing their monthly expenses.
They're digging the hole deeper.
While the rich, they buy assets. They use their income to buy things that generate more income. Stocks, bonds, income-generating real estate.
This gets to that idea in the book, mind your own business.
Yes. This is so important. There's that great story about Ray Kroc, the founder of McDonald's.
He's speaking to MBA students, right? And he asks them, what business am I in?
And of course, they all say, you're in the hamburger business.
And he says, nope, my business is real estate.
Because the real business wasn't selling burgers. It was owning the valuable corner real estate that every single franchise sat on.
So how does that apply to the average person?
It's about knowing the difference between your profession and your business. Your profession is what you do from 9 to 5. You're a teacher, an engineer, whatever. That's you minding someone else's business.
Your employers.
Your employers. Your business, on the other hand, is your asset column. And the problem is most people spend their lives working on their profession, but they never mind their own business. They never build that asset column.
So the advice isn't quit your job tomorrow.
Not at all. He says keep your day job. Be great at it,
Yeah.
but use the income from that job to buy assets, to build your business. Every dollar you get is like a little employee.
I like that. So if I spend it on a coffee, I've just fired that employee.
You fired it. But if you invested in a dividend stock, that little employee goes out and finds more employees, more dollars, and they work for you 24/7.
So what about luxuries? We see rich people with nice cars. They're buying liabilities.
But it's all about when they buy them. The middle class gets a bonus and immediately puts a down payment on a boat. They pay for it with their own sweat and labor.
Okay.
The rich do it differently. They want a Porsche. So they take the $100,000 and buy an asset. First, maybe a rental property. Then they use the cash flow, the profit, from that asset to pay the lease on the Porsche.
So the asset buys the luxury.
The asset buys the liability. You get the toy, but you also keep the wealth-generating machine. You're eating the golden eggs, not killing the goose.
That takes a lot of discipline.
It does. It's the price of freedom.
Now, to do all this, you need what he calls financial IQ. He breaks it down into 4 main areas we need to learn.
Right. The first is accounting. You have to be able to read the numbers to know if a deal is good or bad.
You're flying blind otherwise.
Totally. Second is investing, the actual science of making money. Third is understanding markets, supply and demand. Just because you build it doesn't mean they'll come.
And the 4th pillar.
The law, specifically tax advantages and corporate law. And this is the secret weapon, the corporation.
Yeah, he talks about it like a legal folder.
It really is. And it all boils down to the sequence of how money gets spent. For an employee, the sequence is earn, pay tax, spend what's left.
Right, the government gets its cut first.
But a corporation sequence is earn, spend, pay tax on whatever is left over.
So they get to spend pre-tax dollars.
Exactly. All their legitimate business expenses, cars, travel, meals, are paid for before the government takes its slice. It's a massive advantage, and it's perfectly legal.
The rich just learn the rules of the game.
It really is a complete mental shift across the board, from I can't afford it to how can I afford it?
Absolutely. And that leads to this idea of paying yourself first.
Which sounded terrifying when I read it. He's saying put money in your asset column before you pay your bills.
It sounds nuts, right? But think about it. If you pay all your bills first and have nothing left over, what's the pressure on you?
None. The bills are paid, I'm
No.
safe. You're safe, but you're broke. But if you invest your money first, and now the bill collectors are calling,
Okay, now I'm stressed. I have to figure something out.
you have to get creative. That pressure forces your financial brain to wake up and find a solution. It's like lifting weights. No pressure, no muscle growth.
So it's about making yourself financially stronger, not weaker, in the face of that fear.
Exactly. It forces action instead of complacency.
We've covered a ton here, but I want to end on the book's definition of wealth,
Yeah.
because it's not about being a millionaire.
No. It's a definition from Buckminster Fuller. And it measures wealth not in dollars, but in time.
Time.
The question is simple. If you stopped working today, how long could you survive?
That is a very sobering question.
It cuts through everything. If you make $1 million a year, but you spend $1 million a year and you stop working, your wealth is 0 days. You're not wealthy.
So true wealth is?
True wealth is when the monthly cash flow from your asset column is greater than your monthly expenses.
Because you never have to work again.
You can if you want to, but you don't have to. That is freedom. That is the exit from the rat race.
And that really is the goal. It's not about being greedy. It's about having control over your own life.
It's about autonomy.
So for everyone listening, here's a little challenge. Take out a piece of paper. Draw a line down the middle. Assets on one side, liabilities on the other.
And be brutally honest with yourself about that cash flow.
See where you really stand. Are you minding your own business? Or just funding everyone else's?
And if that asset column is looking a little empty, don't worry. The best time to start was yesterday. The second best time is right now.
This has been a fantastic deep dive. Thanks for mapping out the escape route with us.
See you next time.